Welcome to the show. I'm Maithreyi Seetharaman. It is that time of the year to reflect, so we're back in Brussels to get a status check on Europe's three-year investment plan, which aims to raise 315 billion euros through strategic investments, all aimed at creating more jobs and growth. On the show, we'll catch up with the European Commission's Vice President, Yokki Katainen, 8 months after we last spoke to him about the investment plan and get his take on the progress made so far. We'll dig into the kind of projects that have been picked for investments and then really question how quickly Europe can mobilize more in 2016. Before we go any further, let's get you a quick recap on Europe's #1 priority of this investment plan and how it aims to raise 315 billion euros.
Think of the EU investment package like a brand new empty safe. First to go into that safe, a 16 billion euro EU guarantee, which should be backed up by 8 billion euros of existing funds. Another 5 billion euros will come from the European Investment Bank, so the starting point from Europe in theory is 21 billion euros, with possibly more from member states and their banks. Based on calculations looking at the past, the Commission thinks 21 billion can potentially grow to 315 billion, and here's how. Every €1 of public funds should raise 3 euros in leverage as subordinated debt. In that creditor position, the EU will be the last to be paid out. This should incentivise private investors to jump into the project, taking that 3 euros to 15 euros as senior debt, so these investors will be the first to be paid out, thus taking less risk. If successful, 240 billion euros should go to strategic investments and 75 billion to SMEs.
Now, say you want to build a tram line in your city and it's too risky for commercial financing. You now know you can go to Europe, hat in hand, and they'll put in €1 into your project, which will attract other investors to grow that investment to 15. Now, that €1 came from a pot of 21 billion. Remember, that's the 16 billion EU guarantee and the 5 billion in EIB capital, which all sits under the umbrella of the European Fund for Strategic Investments, and this is how it's structured.
The European Fund for Strategic Investments, EFSI, is managed by the European Investment Bank, the EIB, which also looks after the European Investment Fund, the EIF. Projects are chosen by a steering board, an investment committee and a dedicated EIB managing director. With the focus on generating jobs and growth, chosen projects focus on strategic infrastructure, renewable energy, education and research and development. Small and medium European companies tap into the fund via the EIF, which helps them with riskier growth projects. If you have a financing request, you submit it to the EIB and EIF partner institutions in your country. If you're a project promoter, you can contact the EIB directly. EFSI isn't a new fund. Putting it under the EIB mandate allows the bank to carry out its normal due diligence on project proposals, but allows it to take on riskier projects than normal.
So now that we know how it works, here's what's been done so far. Since April, the EIB has approved 34 projects with EFSI financing of around 5 billion euros, which is expected to raise around 23. It's been done across 13 countries, from Austria to Finland, Slovakia to Ireland, with 9 projects already signed. Now, the pace of investment is expected to pick up in 2016, so Monica Pinner decided to follow the money.
When you're zipping along, taking a fall comes as a bit of a shock, and how quickly you get back on the board can decide how smooth the ride will be going forward. That's the conundrum facing Europe and its steep fall in investments through the crisis. Between 2008 and 2013, investment levels dropped by 17%.
EFSI will guarantee financing of around 49 billion euros through the European Investment Bank and 12 through the European Investment Fund. The goal is to mobilize, in particular, private sectors of investment.
Half of the 34 approved projects target green energy. Other funding destinations include healthcare research and biotechnology, digital and social infrastructure and transport. Plus also providing credit for SMEs. But many, like Guntram Wolf at European think tank Bruegel, say the plan just doesn't have enough firepower to unlock its €315 billion goal.
The real thing that matters for private investor is, of course, the return. The truth is that there's not much reduction in risk through the public sector, and the returns are also highly uncertain. There's too little money, too little public money on the table, and there is not enough structural reforms, single market initiatives that would make investment really attractive again.
That's got Europe looking for other EU funds that can complement the FC project goals, like the European Structural and Investment Funds, which have a recently announced budget of €450 billion, which could be complementary to FC projects and support investor confidence.
I'm afraid we will not get that much additional investment. The aim was really to generate a lot of additional investment. I think we will get quite a bit of investment that gets reclassified, but really additional investment, it's not yet visible in the numbers.
What of the SMEs, though? There's promise there too, as this year the European Investment Fund has pumped €1.5 billion into 62 operations aimed at growth projects for Europe's struggling small and medium-sized firms. That's expected to stimulate a further €19 billion in private investments.
Well, many private investors are interested, and what they need is really they need, on the one hand, insurance for the biggest risks, and on the other hand, better framework conditions, better planning horizon.
That reassurance is now the 2016 goal, to get Europe's investment wheels spinning and fast.
I can think of no better way to get more clarity on where this investment plan is headed in 2016 than to head straight into the Power Hub and speak with the Commission's Vice President, Jyrki Katainen. Come on in with me. A favourite project of yours that you mentioned to me on Twitter was green energy homes in France. If we use that as an example, can you explain in very simple terms how the investment structure of a project like that works?
In France, there are 3 regions. They will pool together 40,000 buildings and arrange financing for renovating those 40,000 buildings. EFSI, the new risk fund, FC, will cover part of the private investors' risk.
Who's a strategic investor in a project like this?
They can be pension funds, insurance companies, investment banks, partially also national promotional banks. The private house owner also pays at the end of the day in the bill.
How do you scale up a project like this? Do you think there's enough clarity in the methodology of picking these projects?
We still have a challenge that some people tend to think that commissions select the projects and the resources are like grants. All the projects which can get financing from FC are selected according to merits by independent investment committee. And FC doesn't provide any grants, but it provides loans, guarantees, equity, quasi-equity, and things like that. It must be kind of high-risk project, higher than what the European Investment Bank usually finances.
Do you think the structure seems to reflect a little bit more of the venture capitalist culture?
Comparing the European venture capital market to American venture capital market, we are way behind the American development. So that's why FC takes more risk. It do fund-to-fund investment, for instance, to private venture capital funds, but also it finances directly projects in a spirit of venture capital.
Is there any particular reason we've not seen more core infrastructure investments?
Usually core infrastructure investments are very massive ones, and it always takes some time to construct the whole project up. And this is probably one of the reasons.
China showed interest in participating in the investment project. Where are the other global investors? Because you need big projects now to reach that 315 billion goal in 2 years.
Yeah, I'm confident that we will manage to finance projects in worth 315 billion in 2.5 years or so. We have a joint working group. Joint means the European Union, European Investment Bank and Chinese authorities, which tries to find the best possible vehicle for Chinese investors to invest in Europe. We want to give them more opportunities to invest through special vehicles, through investment platforms, etc. And those same platforms are open for any other countries. There are many countries from Gulf region, also some American companies have been interested in. I also visited in Singapore, where some fund managers say that they are planning to invest more in Europe. And this year's result is that there will be more or less 15 billion additional investment in real economy. Next year it should be at least double. If looking at the volume, what we are targeting, it's 315 billion in 3 years' time. And compare this to long-term investment level, we are lacking of 300 billion per year, and FC is supposed to finance 315 billion in 3 years' time.
What's going to bring the investors back on the table?
First concrete result, which should happen next spring, is the opening of project portal. It basically means a European-wide website to which both private and public project promoters can bring their projects and they can get better visibility. The second, we will bring concrete proposals on internal market side, for instance on digital single market. In capital markets union, from the beginning of next year, we will flexibilize capital requirements of insurance companies, which will help insurance companies to invest in real economy. Also in energy market sector and in circular economy, we will harmonize the regulation. Basically, Europe has chosen the way forward, and it is to create new market instead of securing the existing one.
Vice President, thank you very much for your time. Here's wishing you a Merry Christmas and a very Happy New Year. We'll see you soon.